Marco is the portfolio manager at TT's China Focused Equity Strategy and senior analyst for the TT Global Emerging Markets and Asia ex Japan Equities. Before joining TT in 2013, he was in the Asian equity team at Manulife Asset Management. Marco, welcome aboard.
Thanks so much. Do you mind unlocking my camera?
Team, could you unlock Marco's camera, please? Thank you. While you do that, maybe you could post up the poll just for everyone to have a look at. Marco's going to be covering a very important topic that is becoming more heated about ESG. Common prosperity is more relevant than ESG in China. Agree or disagree? Marco, you have 8 minutes. The floor is yours.
Great. Thanks so much, everyone. Sorry, and just so I can share screen, bear with me one moment. I'll get the PPT up. Can you see that okay?
Yep, looks good.
Great, thanks so much, guys. So yeah, today I'm going to share with you our views on, I guess, a lot of the common misconceptions by foreign investors on ESG in China, what specifically that is, and ultimately how we try and derive some alpha around that. So without further ado, the key couple points really on my presentation at a high level are that ESG ratings don't actually lead to better performing stocks, i.e. those stocks that are rated A, AAA, and above, really from a performance perspective, oftentimes are far from the best performing. And that usually is because of discrepancies within data sets, in particular that most people follow, I guess, in Western world, which is MSCI is apparently the gold standard, actually has a few shortcomings. So we'll discuss some of those shortcomings and the difference in what we do differently. Secondly is that a lot of people kind of misconstrue, and to, I guess, the panel survey question on common prosperity, the governance of China as a centrally planned economy and the governance structure of companies when it leads to proxy voting as well as proxy voting items, how people view each of the elements which should be approved by shareholders or not. And then finally is there's been, I guess, a host of really interesting investing stakeholders which have ultimately come out to not refute environmental, but call out some of the bad practices, which is greenwashing, from a lot of industry participants during the last kind of 2 years of enthusiasm for ESG, as well as the move towards environment. And then finally, I'll discuss what we do at TT and how we do things slightly differently and how we try to extract alpha. So first point, I guess, is really just on this. Common perception is really China has bad disclosure. They have poor ESG, and there's misalignment with minority interests. I guess one is in terms of points on the environmental side versus emerging markets, it's actually pretty much in line. And again, because of the high number of companies, oftentimes it actually gets misconstrued. So versus DM, it's just a different level of disclosure and a different level of awareness. A lot of the companies we talk to, obviously, we're not activist investors, but we try and urge them to provide more disclosures. Oftentimes, they don't even know who to reach out to. So MSCI, to some extent, should be giving me a little bit of a commission check because we've introduced probably more than a dozen companies to them to provide disclosures. But really, the point is here that MSCI is quite diligent in what they do, but the coverage in China is actually quite poor. And though the common perception is that disclosure is poor, but really it's the lack of their reaching out and their BD departments within the mainland to really drum up business and get coverage. I guess the second point is actually the ESG disclosures, or the counterpoint to point number one or slide number one, is rather the ESG disclosures are improving over time. So it just depends on which service provider you're using. So on the left-hand side here, what we can see is, this is data from Wind, how much CSR reports are actually issued. And there's been about a 70% increase since 2016 in terms of the number of companies reporting the elements, things like carbon emission generation, NOx generation. And that will only further improve as at the end of 2023, beginning of 2024, this is something that's regulated by CSRC. Versus common misperception, which is Bloomberg, MSCI, their coverage has only improved by about 27%. And then furthermore, I guess, is as these Chinese companies learn to provide the correct data sets in the required data forms, which MSCI and foreign providers request, the improvement in ratings is there. And you can see that on the right-hand side. Lastly is actually just on linguistics and a bit of the ability of some of these Western providers to really dig deep. Not all the companies listed in that kind of 1800 reported figure by Wind is actually in English or published in English, and therefore, again, takes more time. But what is quite interesting is, again, amongst the different data vendors, and there's about a half a dozen Western data providers, there's about half a dozen Chinese, there's different scoring methodologies. Most guys usually have E, S, and G, and they weight them equally. But within the weighting of those particular E, S, and G, there's different sub-weighting, and that can vary and cause a lot of different distinctions. And what we can see is Sintao, which is one of the kind of leading ESG independent providers, actually has a very similar weighting to Wind and FTSE are quite similar, but it's very different than MSCI. And so, again, this is something that often gets misconstrued, but certainly requires a bit of attention. The methodology, as I mentioned, is very similar across the board. E, S, and G are the big three core items, but the scoring is very, very different. And so that's the kind of key point on this slide. Within performance, interestingly, on the top left-hand chart, this shows the average above median ESG rating. So those that are kind of better than double B in China, rated both from MSCI as well as Singtao, which has multiple times many more coverage. Actually, those good rated companies, i.e. the ones I mentioned, A and above, don't necessarily perform all that well over a series of time. But what actually is more important is the rating changes. So as you can see from the bottom right-hand chart, ratings upgrades are followed. So people do care about ES and G, depending on the sub-item, but those actually do lead to better performance rather than having that gold standard rating. Second point is, I mentioned just on the kind of company structures being very different. This blanked out the company here. It's a battery maker. It's not CATL. It's one of the others. But really, China is a very different place. Oftentimes, people perceive what's requested in proxy voting as bad. Approving bond financing, approving investment plans and financial budgets as bad because there's a lack of disclosure. But what ISS doesn't really recognize is most of these companies, when they go to public financing and raise financing, have to get CSRC approval anyways. And there's a secondary prospectus. So it's a lot just about education of some of these service providers rather than that these companies are necessarily not following the best practices that global investors look for. And then point number three, as I say, we're running out of time, is really we've seen a mass increase in growth of the financial sector investment into green investing and predominantly climate funds. This is from Morningstar. We can see that there's been massive amounts of billions, and this is specific to China as the second largest attractor of capital in 2021. But really, green investing and great clean energy, low carbon, climate conscious investing does not equal good ESG practices. This is an example. This is the number 2 largest onshore environmental fund. You can look it up. I won't bash a competitor, but the number 1 company in terms of their weighting is Zhejiang Huayu Cobalt. Google AB documentary on Congo and watch a 50-minute documentary on how these companies mistreat their employees, use child labor in their labor practices. So MSCI isn't doing any sort of proper due diligence. It's a B-rated company. And then we've got CCC rated companies in the mix here. So whilst they're environmentally friendly companies, they've got great performance, they're not fully encompassing the other elements of ESG. Furthermore, this is the leading number 1 ESG leading fund in China. It's an ETF. And again, interesting enough, Maotai, big weight in the index, CCC rated mainly because of the water rights usages. The kind of sticker on the tin is that it's a leading ESG fund, and yet their biggest investment is quite counter to that point. So there's a lot of greenwashing in the industry. Key message here is really buyer beware. And what are we doing differently? Ultimately, we're not an ESG fund. We're an emerging markets fund. I run a China fund. ESG ratings are ultimately snapshots. They're not permanent in nature. Our job is actually to try and fill in the blanks to make these companies improve their ratings so that we can unlock some of that alpha. But B is really to educate the companies as to what is considered to be best practice. We're not here to exclude. I think if you guys all listen to Professor Damodaran from NYU Stern, he's got a really great podcast done last week, and he basically picks apart the sector in terms of charging more, for less, narrowing the investment universe and charging an extra 20 to 25 basis points. That's not what we do. Ultimately, our job is not to exclude. Our job is to engage with companies. And we do so through a dedicated ESG team. We've got I think 3-person team, sits out of London. We've got a research advisory board, which is about 4 or 5 people. Dr. Jun Ma, who's chairing a lot of the green initiatives within China, sits on that board. And we document all of our ESG investment making decisions to see how they've actually performed, to see whether or not they've added value. And sometimes, the market doesn't follow us, but we stick true to our knitting. And ESG is actually a crucial part of our investment process. So stop here, open it up to questions.
Great. Thanks a lot, Marco. That was a good one. Daniel, from the allocator side, you have the floor and you have 7 minutes, I believe. We'll just round it off for you for 8. Go for it, Daniel.
Perfect. Thanks a lot. Thanks, Marco. Exactly. I was looking for this, the poll results. Not surprisingly, 77% says common prosperity is more relevant in ESG in China. And this is exactly the question I would like to start the conversation. We all know TT is pretty renowned for its ESG efforts, and especially in emerging markets around the world. And then you made a very comprehensive presentation about your approach in China. And yet at the same time, China came out with what they call common prosperity, which, at least in my own opinion, have a lot of overlaps, at least with what the West has been talking about the ESG. How do you see these two coexist? And then what have you been doing to try to make sure that you can extract the opportunities being driven by these movements on both common prosperity and ESG?
Great, thanks, Daniel. Yeah, ESG is actually synonymous with common prosperity if you think about it in a grand context, because everyone recognizes when we actually do our pitches, really, when we talk about ESG, it goes the other way around. It goes G, governance first, i.e. alignment of shareholder interest with the chairman or the key stakeholder driving and key decision makers driving the business, environmental, which has been a very hot space for investment in the past, call it 2 to 3 years, but more so, S is the common prosperity as part of the social aspect, which has been forgotten about, really. Governance was, you can call it, if you want to look in the last 10 years, China frauds happened very rampantly 10 years ago, probably less so now with the exception of maybe Luckin, but there was a lot more of that. So that phase was fixed through governance, people caring about governance, people caring about fraud. E was obviously the big part about the environmental push and COP20 and people coming around to that. And S is really, I think it's synonymous. So when we look at Meituan and what their contribution is and how they extract value, it's actually, they're one of the largest employers now of drivers. So it's synonymous in terms of, and seamless within our processes. How are people going to react to this if they find out these practices are not aligned with societal benefits and societal harmony, really?
Thank you. There's a follow-up question on that from the floor. And in fact, actually also what I want to ask as well is that, we talked a lot about the importance of be it ESG or common prosperity and all that. But always, I would like to ask managers is that, how do you actually quantify, let's say, the returns or at least the alpha that you actually brought along with it? Have you guys tried to come up with some sort of analysis to see how these sort of ESG factors or common prosperity and whatnot have actually contributed to the bottom line of the returns?
Yeah, in all honesty, we haven't yet because there aren't enough examples where we've made key decisions based on the ESG outcome. But, like I said, we've won some, we've lost some. I'll give you 2 examples. East Money, they're an online broker. It's a company well loved by A-share investors. They hired a CFO, and that CFO basically was involved with the previous fraud in a Chinese ADR about 7 years ago. We uncovered this basically because my colleague, who's our head of ESG, went to Harvard. We were trying to engage with the company. The company does not see shareholders at all, will not engage with investors. And we subsequently used that as a bit of an excuse or reflection rather, on the governance of the company and the engagement of the company. And we sold out. What happened to the stock? It probably ripped another 40%. So you can detract that as negative alpha. But had that have gone the other way, where there was some fraud, then certainly we could commend ourselves as avoiding that. Within our process, ESG isn't the only bit. It's not just about governance. There's also forensic accounting that we do. There's a lot of companies that are in fact very aggressive in their accounting practices. So we've avoided a lot of companies which tend to end up underperforming over time, but quantify it in terms of how many basis points or how many percentage of alpha, I think we don't have enough concrete examples where because of X ceteris paribus, we can attract that entirely as it's a part of our investment process.
Right. So consideration of the timing. Last bit I want to ask about, it's the topic of greenwashing, right? When it first came out, when people are talking about China doing ESG, I think a lot of allocators jump on and say, hey, look, this is probably the place in the world that we're going to see the most greenwashing that we can ever see before. What's your experience on that? And not only that, I want to know how you can avoid the troublemakers. Is there a way actually to exploit this, as in converting that into alpha, by understanding how the practice of greenwashing has been being held out by some of the companies in China?
Well, given just the rapid growth of the industry, I would say it's going to take a bit of time for people to get called out. China in particular isn't the most forthcoming in terms of, calling out bad practices. I mean, Me Too is starting to get a little bit of press, and that's driven by mainly a top-down directive. Ultimately, if this was a completely free market in terms of the A-share land, these companies would be shorted on. But unfortunately, there's a lack of borrow only really on things that have QFII quota. So there is elements where you are able to call it extract alpha, but that's not our job. Our job is to go out, find great companies, invest into them and help them grow, help them understand what's the deliverable on getting those ESG accreditations rather than just trying to play the game. I mean, it's quite funny because we look at the list of companies which are AAA rated. There's e-cigarette companies in there. There's electric scooter manufacturers, mainly those that are lead acid battery guys they are moving in the right direction. But these are AAA rated companies which have learned to play the ESG game, get the accreditation and fit themselves into the box such that they get the investment dollars from some of the passive money. There's a lot more passive, I would say, product that's been sold over the last bit. And, I haven't broken down that slide, which was about $50 billion of AUM, but yeah, there's a large part of it which is there and they're thematic, and that's the style that these funds and the kind of stakeholders help to raise capital with.
Okay, final question. Have you been encountered by investors or clients that now insist that you have to apply ESG factors into your China investing, or else they won't allocate at all? Or they actually single out China as in somewhere that is still very sort of in the preliminary stage, and then they probably put, let's say the importance into other factors rather than ESG?
Yeah, we've seen some prospects in Scandinavia that are very rigid in their practices. I mean, to the point when we're bringing our pitch books and they say, did you carry these over from Hong Kong? And do you guys look, we're not an ESG fund, but that is the level of sensitivity that some investors do have. And it's a trend, certainly something that we respect. We carbon offset. So obviously, this particular prospect saw our carbon offset FCA accreditation and asked if we printed them and brought them over in a suitcase versus using iPads, and we got into a big debate. But yeah, there certainly is an increasing amount of people that want to see that as part of the process. And ultimately, it's funny because one would think that China doesn't care, but domestic investors, as I just indicated in my slide deck, they do care on these incremental changes. There is an alpha opportunity here.
Thank you. Thank you very much, Marco. I think that's very comprehensive and get to understand GT's approach in doing ESG investing in China. And yeah, that's all from me on this panel. Thank you very much, Marco, for joining us.
Thanks, guys. Thanks for having us.
Thanks, Marco. Thanks, Dan.